Welcome back to section 16. Now you know how to find, analyze, and value an investment. You know when to enter in a longer term stock position, and you also know when to enter a shorter term options trade. There are two more things you need to learn before you construct your entire portfolio. You need to know proper risk management and position sizing techniques. Once again, we are not your financial advisors. We're not here to give you specific investment advice or recommendations, and the companies that we do talk about in this section are to be taken as educational and illustrative purposes only. So I shared this quote with you once before, and it's definitely worth repeating. Rule number one, never lose money. Rule number two, don't forget rule number one. This is Warren Buffett's most famous quote. We will never be 100% right all the time. Not even Warren Buffett's right all the time. But there are ways to limit the amount of money lost in our portfolio. And the first way to do this is by using proper risk management strategies. Every investment carries some level of risk. Even cash and money markets have risk. As a matter of fact, Warren Buffett has said that the riskiest asset class is cash and money markets. That sounds absurd since they're guaranteed and FDIC insured, but over time the stock market has always rebounded even after the horrible crash of 2008. The market has also outpaced inflation by a wide margin over the long term. However, cash and cash equivalents, such as money markets, have inflation risk, and they may not earn enough over time to keep pace with inflation and the rising cost of living expenses. As I'm recording this, interest on a savings account is about 0.1% interest. However, the 20-year average rate of inflation is 2.4%, so we're actually losing money by putting money into a savings account or money market account. So it's pretty safe to say that if money markets and savings account and other types of cash assets have risk, then all investments have some type of risk. How do we combat that? The first strategy is asset allocation. This is when you invest your money into several different types of asset classes, and examples are stocks, real estate, bonds, annuities, CDs, and precious metals, just to name a few. I'm 41 years old, and I own a few investment properties, but the rest of my money is allocated into value stocks. My clients who are older than I am have money invested in stocks, but they also have safer investments such as bonds and bank deposits. Asset allocation helps reduce the risk of major losses that can result from overemphasizing in a single asset class, however resilient you might expect that asset class to be. Based on your age and your risk tolerance, you may only want to put a small percentage of your total liquid net worth into value stocks. Another risk management strategy to use is diversification. When you diversify, you divide the money you've allocated into a particular asset class, such as stocks, amongst various categories of investments that belong to that asset class. Diversification, with its emphasis on variety, allows you to spread your assets around. In short, you don't put all of your investment eggs into one basket. And examples of diversification in stocks would be to invest in large cap stocks, mid cap stocks, and small cap stocks. And you can also diversify even more by investing in a portion of your portfolio into several different sectors or industries in the market, such as retail stocks, airlines, utilities, software, energy, industrials, healthcare, and consumer durables. And these are just a few different sectors that are in the market in which you can invest. There are three main types of risk when it comes to investing, and we want to create a portfolio that will protect us from a lot of these unnecessary risks. The three types of risk are industry risk, non-systematic risk, and systematic risk. Industry risk is the risk that is associated with a particular industry. For example, if the company that you're investing in invests in oil and gas, they would likely be affected by any good or bad news within the energy sector. Therefore, if oil prices fell, the company's stock price would likely decline. A rising tide lifts all boats, as they say, which is great if you're in an industry that's been performing well. But if you invest too heavily into one particular industry, and if that entire industry becomes out of favor, then you could be exposed to a lot of unnecessary risk. Whereas Buffett says, you only find who's swimming naked when the tide goes out. There are dozens of industries in the market to invest in. We don't need to invest in a million companies to have a properly diversified portfolio. So there's no need to have any more than one company in any given industry. And since we're looking for companies with a wide moat, we'll be investing in the best company in any given industry. We want the industry leaders, so there's no sense investing in the companies that come in second or third place. We just want the number one company in each industry. Next is non-systematic risk. This risk applies to investing in an individual company. For example, if you buy shares of ABC common stock, you assume the risk associated with that specific company, as well as the risk of the industry in which the company resides. The risk associated with the company involves such things as the decisions made by the management team, as well as the financial structure of the company. This is why it is utterly important to research the management team. It's impossible to remove all investment risk, but there are ways to minimize it. Much of non-systematic risk can be reduced by buying companies with a solid management team in place. And thirdly is systematic risk. This comes with investing in general. All investments carry some type of risk. For example, if you invest in the stock market, you will be subject to the risk associated with stocks. And in 2008, just about every company declined, no matter how great that company was. Apple was about as great of a company as you could find back in 2008. However, due to the crash of the Great Recession, their stock fell from $26 a share split adjusted in January of 2008 to a low of just $10 a share in 2009, or approximately $182 a share down to $70 a share non-split adjusted. If you invest in bonds, you'll be subject to the risk of rising interest rates. In general, systematic risk cannot be eliminated, but it can be properly managed. And one way to manage that risk is by diversification. Another way to manage the risk is to get your principal off the table as soon as possible. And this is done by lowering your cost basis. Dividends lower your cost basis, and selling puts and calls reduce your basis as well. Buying more shares at a lower price also lowers your cost basis. In the previous example, if you knew Apple was a solid company and it fell from $182 a share down to $70, a wise value investor would see that as a huge opportunity. And the investor who took advantage of that saw Apple rebound from $70 a share all the way up to $700 a share before they had a 7-for-1 split shortly thereafter. In summary, proper risk management techniques will help you reduce many types of investment risk. And here's how we combat those investment risks. First is asset allocation. We want to invest in different asset classes. Next, we have diversification. We're going to invest in different categories of stocks, such as large cap, mid cap, and small caps. And then we're going to combat industry risk by investing in several companies that are in different industries. Non-systematic risk. We're going to buy companies that have an excellent management team with a track record of success. And lastly, we're going to try to combat systematic risk by diversifying our assets and lowering our cost basis at every opportunity. So next up is position sizing. This refers to the percentage of your portfolio you allocate into any one particular investment or trade. If I have $100,000 and I buy $10,000 of Apple, then my position size is 10% of my portfolio. And there are two schools of thought on position sizing. First, it's hard to keep track of several investments, and it's better to know everything you possibly can about just a few companies. Therefore, position sizing that's very concentrated, say 20% or more into one investment, may make sense. Several successful hedge fund managers apply this school of thought. Warren Buffett, although he owns several businesses, most of his wealth is allocated into a small number of holdings. The top 4 holdings in his portfolio are Wells Fargo, Coca-Cola, American Express, and IBM, and that makes up 63.5% of his $70 billion portfolio. Bill Ackman's another hedge fund manager. He runs Pershing Square, and his funds done pretty well. It's averaged 27% over the last 10 years. And his multi-billion-dollar portfolio consists of just 6 holdings. There's a big difference between those investors and the rest of us. They're seasoned investors with an incredible amount of portfolio management experience, and they also have huge teams of research analysts working for them, as well as billions of dollars in the bank. For the rest of the world who have less investment experience, you shouldn't risk such a large percentage of your total liquid net worth on any one trade. Position sizing is the first and probably the most important way investors can protect themselves from what is known as a catastrophic loss. This happens when you get a little too excited about a particular investment. And instead of thinking about a possible worst case scenario, you start to think about the potential returns that you can make on this investment. So you make a huge bet and you swing for the fences instead of investing a properly allocated size based on your experience and risk tolerance. If your $100,000 portfolio fell to $60,000 because a huge bet sure thing fell apart, it's going to take you a very long time to get back to break even. That one loss, which cost you 40% of your portfolio, will have to grow by 66.5% just to get back to break even. To put that into perspective, how long can it take us to recoup a loss of 66.5%? Well, the S&P 500 index has averaged a rate of return of 7.14% over the last 15 years based on Morningstar stats. That means it's going to take you 9.31 years just to recoup that loss. I don't have 9 years to wait, and I'm sure you guys don't have that long to wait either. That leads us to the second school of thought on position sizing. Stay diversified. We don't know everything about every company, nor do we have a highly compensated staff do the research for us. Therefore, we need to allocate our positions into smaller percentages of our portfolio. If you have a major loss, you're going to live to see another day. Most great investors will tell you never put more than 3 or 5% of your account into any one position. And with dealing with more volatile vehicles such as cryptocurrencies, position sizes should be much smaller, like 1% of your portfolio. Dr. Paul Price, he's one of my mentors, he told me the same thing. Never put more than 5% of your portfolio into any one investment. And he's an experienced investor. Dr. Price was good enough as a money manager that he was able to retire at the young age of 50. And now he writes an article a day for Jim Cramer's website, TheStreet.com. If this experienced investor follows the 5% philosophy, I'm going to do the same thing, and hopefully you will too. Using appropriate position sizing will allow us a lifetime of success as investors. Here's an example of a hypothetical $100,000 portfolio. $100,000 times 5% maximum allocation means that we can put $5,000 maximum into any one investment. So $100,000 divided by 5,000 means we can have at least 20 holdings in our portfolio. This doesn't mean you have to rush in and purchase 20 positions right away. You can start out with 1 or 2 companies to invest in. If you find 1 or 2, you can also use some of the money to sell puts on stocks that pass our value investing criteria but are not currently at a discount price. And the rest can be in a money market account until you find other opportunities. At any given time, my allocation between long-term value stocks and shorter-term puts change, and they change depending on the market conditions. If the market is undervalued or even fairly valued, I'll have just about all of my liquid net worth invested in value stocks because it's much easier to find bargains when the market's undervalued. In a market such as the one that we're in right now, February 2017, where the market's hitting record highs, it's becoming very difficult to find great companies that are at discount prices. Most great companies are at ridiculously overvalued prices. Therefore, I'm not buying any value stocks right now because I can't find any. I have most of my investments in shorter-term put options at this time, and they're put options on stocks that fit the value investing criteria at a margin of safety if put price that I'm satisfied with. In a normal market environment, which I haven't seen one in years, I think a pretty good allocation for a stock portfolio would look something like this. Put 70% of your money into stocks, 20% into options, and then 10% into cash. 70% value stocks, this is where your long-term wealth will be made. This money will be invested for the long term. And the buy rate strategy that you learned in section 12 could also be done in this section of the portfolio. So if we take 70% of our stocks in this hypothetical $100,000 portfolio, we have $70,000 divided by 5,000 max, gives us at least 14 holdings that we can allocate towards value stocks. Then we're going to put 20% into shorter term trades, most likely put options. And short term is less than 2 years until expiration. This will either pay you for your time to wait, or ideally will get you into a position that you want but at a better price. 20% into this strategy will allow us at least 4 holdings to put into put options. And then we're going to have 10% into cash for money market securities. This is just a parking spot for our capital until we find something worth investing in. In an overvalued market, it's perfectly fine to have more money than usual sitting in cash. Don't worry that you're not making a return on that money. It's not permanent, it's just temporary. But think about how those assets are going to be protected against a possible correction. If we have 10% in cash, it's $10,000 divided by 5. That means we have 2 potential holdings when the time is right. Value investing has been one of the best investment strategies of all time. Benjamin Graham started back in the 30s, Warren Buffett started it in the 60s, and it still works to this day. You can see how Warren Buffett has used it to become one of the wealthiest individuals in the world. As of the date of this writing, his rank in the world is number 3, right behind Amancio Ortega, who's a Spanish businessman, and in first place is Bill Gates. As great as this strategy is, it's not worth anything if you lost all of your money making stupid big bets. Once you get better at this, you can increase your position size if you can stomach the risk, but until then, you need to play it safe and reduce that risk by using the risk management strategies that you learned at the beginning of this section and by using proper position sizes of 5% or less into any one investment. And remember the two most important rules of investing. Rule number 1, never lose money. And rule number 2, don't forget rule number 1.